August has delivered a new set of economic challenges for the United States, and the Federal Reserve now finds itself at one of the most difficult crossroads in recent years. The CPI, or Consumer Price Index, most widely watched measure of inflation, has jumped 0.4% in August alone. That may sound modest, but it represents the sharpest monthly increase since January. On a yearly basis, inflation is now running at 2.9%, the fastest pace in more than 6 months. And when you strip out the food and energy categories that tend to swing wildly, the so-called core inflation rate is still stuck at 3.1%. That's more than a full percent point above the Fed's official target. Digging into the details, the biggest contributors are the costs that hit consumers directly. Gasoline prices climbed nearly 2% in just 1 month. Grocery bills got heavier too, with tomatoes, apples, and beef leading the increases, and anyone booking a trip felt the pinch. Airfares jumped almost 6%, while hotel rates rose more than 2%. Now, these increases are being driven by lingering supply chain disruptions, the labor shortages, and businesses passing along high costs that are partly the result of tariffs and ongoing trade tensions in the US. But while the prices are heating up, the job market is cooling down. Weekly unemployment claims rose by 27,000, hitting 263,000, the highest level in nearly 4 years. Hiring has also slowed dramatically. In August, the economy only added 22,000 jobs, well below the forecast, and a steep drop compared to earlier this year. Now, the unemployment rate has edged up to 4.3%, its highest since late 2021. And broader measures of underemployment, which capture people working part-time or discouraged from looking for work, also has ticked higher. Now, economists warn that these may be early signs of a labor market losing momentum, with the risk of more layoffs on the horizon. Now, that leaves the Federal Reserve with a dilemma. On one hand, the inflation is still running too hot, and on the other, the labor market is starting to crack. Normally, high inflation argues for tighter policy, rising or holding the interest rates high to slow the demand. But rising unemployment and weaker growth argue for the opposite, cutting rates to provide relief. At their upcoming policy meeting in mid-September, Fed officials are widely expected to begin an easing cycle, lowering the benchmark interest rate from around 4.3% to 4.1%. It would be a modest move, but symbolically important one. The first step towards loosening the monetary policy after a long stretch of keeping the conditions tight. Fed Chairman Jerome Powell has also been cautious with his messaging. Earlier, he acknowledged that there is a need to support jobs, but he also insists that inflation is not yet fully under control. Fitch Ratings has also sounded an alarm on America's outlook, projecting subdued GDP growth for FY26. Now, the agency cites risks from trade disruptions, geopolitical uncertainty, and persistent inflation, all factors that could dampen investment and slow the pace of recovery. In other words, the US economy is walking a tightrope. Inflation is proving stickier than expected. The job market, once the strongest pillar of recovery, is now showing cracks, and the Federal Reserve must decide not only whether to act but how quickly and how forcefully. The coming months will be pivotal. The stakes are high, not just for Wall Street but for Main Street households coping with rising prices, uncertain job prospects, and the ripple effects of the Fed policy decisions.
If you like this video, then like, share and subscribe to ET Now.